In 2026, a quiet but historic shift is unfolding behind closed doors at central banks around the world. While most investors remain focused on stocks, bonds, and interest rates, central bankers are quietly making a very different bet. That bet centers on one asset that has survived every financial crisis in modern history. Gold is once again becoming the centerpiece of national reserve strategies. The scale of these purchases is raising eyebrows across global financial markets. Some analysts believe we may be witnessing the largest reserve transformation in decades. The obvious question is simple. Why are central banks rushing toward hard assets now? To understand the answer. Currencies, because they represented economic strength and political stability. Place, for generations, governments trusted paper, but confidence in any currency ultimately depends on trust, and trust can be challenged by debt, inflation, and geopolitical uncertainty. Over the past decade, all three pressures have intensified across major economies. That reality has forced policymakers to reconsider how national wealth should be protected. Gold offers something paper currencies cannot provide. It carries no counterparty risk. It cannot be printed by a central authority, and its supply grows only slowly through mining production. Those characteristics make gold attractive during periods of uncertainty. Yet, this story goes far beyond simple inflation protection. A deeper geopolitical transformation may also be underway. Nations are increasingly seeking diversification away from concentrated reserve holdings. Gold has emerged as one of the few universally recognized alternatives. Every major purchase sends a signal to global markets, and the message behind the 2026 gold rush may be far more important than the metal itself, because what central banks buy today often reveals what they fear tomorrow. And right now, many institutions appear increasingly concerned about long-term currency stability. Around the world, government debt levels have reached extraordinary heights. Servicing that debt becomes more difficult when borrowing costs remain elevated. That challenge creates difficult choices for policymakers. Gold fits naturally into that strategy because it is globally recognized. It can be held directly without dependence on another country's financial infrastructure. It remains valuable regardless of which currency dominates global trade. That neutrality makes it uniquely attractive to reserve managers. Yet there is another layer to this story that receives far less attention. Several emerging economies have been steadily increasing their gold reserves for years. These purchases are often gradual, strategic, and carefully planned. They are not reacting to a single event. They are preparing for a range of possible futures. And that preparation may reveal more about the future of money than any headline ever could. Raise taxes too aggressively, and economic growth can slow. Cut spending too deeply, and political pressure can intensify. Expand money supplies too rapidly, and inflation risks can return. Gold exists outside that entire policy debate. It is neither a promise nor a liability. It simply exists as a tangible store of value. That distinction is becoming increasingly important in an era of financial uncertainty. Another major factor is the accelerating trend toward reserve diversification. Many nations no longer want their reserves concentrated in a single monetary system. Instead, they are building broader foundations designed to withstand multiple scenarios. To understand where this trend could lead, we need to examine the changing architecture of the global monetary system. For decades, international trade operated within a relatively predictable financial framework. Nations accumulated foreign currency reserves to support trade and economic stability. Those reserves acted as financial shock absorbers during times of crisis. But the definition of a strong reserve asset is evolving. Today, resilience matters just as much as liquidity. Policymakers are increasingly asking how reserves would perform during extreme global disruptions. That question became especially important after a series of major economic shocks. Financial systems proved resilient in many ways, yet vulnerabilities also became impossible to ignore. Supply chains faced unprecedented strain. Energy markets experienced dramatic volatility. Inflation surged in economies that had not seen such pressures for years. These developments changed how many reserve managers viewed risk. The objective shifted from maximizing efficiency to maximizing resilience. Gold became an increasingly attractive component of that equation. But gold is not the only tangible asset attracting attention in the world. Interest in strategic resources is rising rapidly. Nations increasingly recognize that real assets can strengthen economic security. The concept is straightforward. They represent something real within the physical economy. That reality is becoming increasingly valuable in a world dominated by digital finance. Some experts describe this as a rebalancing rather than a revolution, and if they are correct, the great gold rush of 2026 could be only the beginning. The implications of this shift extend far beyond central bank vaults. They could eventually influence everything from currency markets to global trade relationships. Investors are already watching these developments with growing interest. Many are asking whether central banks are signaling a broader transition in financial thinking. Historically, reserve managers tend to prioritize stability over speculation. That makes their actions especially important to study. Unlike short-term traders, central banks often plan decades into the future. Their decisions are typically slow, deliberate, and deeply strategic. That is why the pace of gold accumulation has captured so much attention. Some analysts believe the world is gradually moving toward a more multipolar reserve system. In that environment, diversification becomes increasingly valuable. Gold serves as a bridge between competing monetary systems. It carries thousands of years of monetary history and global recognition. Few other assets possess that level of universal acceptance. That does not necessarily mean traditional currencies will disappear. Instead, the future may involve a more diversified balance of reserve assets. Central banks appear to be positioning themselves for exactly that possibility. The broader message is ultimately about preparedness. Nations are building financial systems designed to withstand greater uncertainty, and hard tangible assets are playing a growing role within those strategies. Whether this trend accelerates or stabilizes remains uncertain, but the direction of movement is becoming increasingly difficult to ignore. The Great Gold Rush of 2026 is not simply about commodities. It is about how nations define security in a rapidly changing world, and the decisions being made today could shape the next era of global finance for decades to come. This content is for educational purposes only. It is not professional financial advice. Investing involves risk. Always do your own research.